Hey guys, it's Mike Palmieri again. Today I want to share with you what a good investment looks like. So again, one of the biggest mistakes that new investors make is they kind of pull off a one and done. They pick some investments that they're excited about and they start kind of just pulling the trigger. And most of the time they end up really running out of money to commit to those positions. So excitement gets the best of them, and 6 to 12 months down the line, they often find, that position might be down 30, 40, 50, or even, 60 plus percent. So I want to introduce a technique that I often use that's called position scaling. It's a little bit different than building positions via a dollar cost averaging, and it more so takes into account the risk profile of the asset that we're talking about. So just want to be clear that this isn't investment advice. I'm just simply demonstrating an example of what this process looks like. And anything can happen in the near term. I am a long-term investor, so that gives you a little bit more opportunity to use this strategy to your advantage. So you can see here we have two different positions: the Walt Disney Company and Zillow Group. Disney, you can see if you look over the past 5 years, it's much less volatile than that of Zillow Group. So the way that we want to incorporate that potentially into a build strategy is a couple things. One, with Walt Disney, we're going to want to get to our initial goal position a little bit faster than we would with Zillow. And so you can see here, there's also only potentially 4 buy targets that we're looking to pull the trigger versus 7 buy targets with Zillow. So with a riskier asset, we're extending the number of buy terms, and we're also extending the volatility index because we know these types of assets are more risky and they have the potential to fall a bit further. So we want to take advantage of that in our build strategy. So the other thing I just want to point out is you can set up these build strategies. Over time, they kind of end up being like second nature. So I don't really use them as much as I used to. But you can also transition these type of strategies to a dollar cost averaging strategy where you're just building the same amount essentially over the same time block. So say, $100 every 2 weeks or something like that. So if this isn't panning out and, it's going up and up and up, which is very rarely the case, a lot of times we'll have the opportunity to take advantage of volatility. But if it isn't, you can always use that dollar cost averaging as a crutch to this not working out potentially. So I'll use a specific example that I went through with Zillow Group. So I've owned the stock for a few years now. I started buying the company around $27 when a lot of people, were really uncertain about the future of the company. And we're finding out, today that they were right about a lot of those things, but a lot happened in between where there were opportunities to take advantage of this volatility. So I started, I started buying the position in the 60s around its first hot cycle. So it seemed like, it was just going up and up and up. So even me as an intermediate or an advanced investor, I felt like I really needed to get a position built in that. So I started building a little bit into it around $60. And a few months down the line, my position was down around 50%. But in this case, it was part of the plan. So I recognized, that Zillow doesn't have a healthy balance sheet and it has really high, extraordinary volatility. So I like the company in the mid to long term, but in the near term, I understand, that it's going to fluctuate quite a bit. So if we're looking at this here, if we say, if say we bought it, after that hot cycle went through and it was around $100, we might want to plan a buy, our next buy target 10% down from that at $90, and then plan a third buy $80, fourth buy $70, et cetera, all the way down to potentially 40. And you won't always get there. Um, and we're not necessarily trying to time the market or anything like that. We're more so using the risk profile of a security to understand and be an intelligent investor that we know, how these have the potential to move. Um, so when you look at that, you can see, another thing that you want to consider is that your first initial buy should be a smaller capital amount that you're putting into the asset at that time, and then as it falls you want to potentially up the ante a little bit, so really lowering your average share price down and taking advantage of that potential volatility. So I personally did this with Zillow. So again, I started buying it around 60, around 27 were some of my bigger buys when they introduced the home flipping business, and a lot of people were really uncertain about that and they didn't think it was a good idea. And again, they turned out to be right. But in between that, those 60 and those 27 buys where it accumulated a really large number of shares, it went way up from there up to over 210. I think the high was around 215. So this type of build strategy, it worked out really well in this particular instance. And the other thing, that you also want to keep in mind is having the same type of potentially exit strategy. So again, I'm a long-term investor, but I'm also a realist. So I know when something makes that kind of movement in the near or midterm, a lot of people are going to be taking profits. And again, it's a volatile asset, so it has the potential to turn back the other way pretty quickly. So one of the things I always try to do is I try to reserve some of my principal commitments on the other side. So when it's kind of going back up through the top tiers there. So for this particular one, I set a milestone, a couple milestones of being up 50%, 100%, 200%, 300%, et cetera, to take out a certain percentage of my principal commitment to recover that principal and reduce some of my risk exposure. So it worked out really well. I have somewhere around at one point around 1,000 shares or so, and on the way up through 150, 200, 215, et cetera, I was able to reduce that to around somewhere around 300 shares at the top, and it worked out really well because it ended up turning the corner. And again, a lot of people were right about that home flipping business. They ended up getting into quite a bit of mischief with it, where I think currently the share price is somewhere around $50. So I'm kind of back on the other side where I'm starting to scale back in again and build up some of that share accumulation because I still do like the company in the long term. But this is kind of how you want to handle this type of riskier asset. So you don't want to necessarily ignore it. Like a lot of people say, oh, it's risky. You want to take advantage of understanding what that risk profile is and incorporate that into build and exit strategies along that volatile path to make sure that you're not committing large amounts of money at any particular time, but you're committing more and more as the volatility goes up and the share price drops. And again, if it's something you really like and that doesn't end up working out, then you can always transition to a dollar cost averaging strategy. So say here, it went from 100 and it just kind of kept going steadily up against what our expected profile of it is. We could potentially set a time block of 2 weeks or a month where we commit a certain amount to get to our initial position that we want to build into. Flip side of that, Walt Disney. So here in Zillow, we had potentially a 60% downside Walt Disney, we're only accounting for more of a 15% downside in our build strategy to get to that initial position. And this isn't the full story. This is just giving you guys an idea, of an experience that I've found to be beneficial when I'm considering the risk profiles of different securities. And I talk about that and exactly how I do that in my book, Quiet Mike Speaks: The New Age Guide to Generational Wealth. So I'll tell you, what I define as asset classes as a whole, and then I'll go into individual securities on how I gauge for that risk further within those asset classes, and how I kind of build these positions based on those two factors. But hope you really enjoyed this, and if you have any comments or feedback, feel free to leave it down below in the comments. And any other topics you want me to discuss, I'd be happy to. This is something I'm really passionate about, and I'm enjoying trying to get as many people on the path to wealth and accumulating as much wealth as they have the potential for. So again, Quiet Mike Speaks: The New Age Guide to Generational Wealth. If you're interested in learning more, available on Amazon, Barnes and Noble, and many other outlets. All right, so that's it for today. Thanks for joining in, and we'll chat again soon. Thank you.